When markets suddenly fall and fear spreads across financial charts, something powerful happens inside the human brain. Prices drop quickly, red candles appear everywhere, news headlines talk about crisis, recession, or collapse. And in that moment, many traders feel the same emotional reaction. Fear. The interesting thing is that this fear does not come only from the market itself. It comes from the way our brain interprets uncertainty and loss. Financial markets may appear like numbers and charts on a screen, but the decisions behind those numbers are made by human minds. And the human brain reacts strongly when it senses danger. In this video, we are going to explore something extremely important for every trader: what happens in the brain during market fear. Because when traders understand the psychology and biology behind fear, they gain a powerful advantage. Instead of reacting emotionally, they can observe their own reactions and manage them more effectively. If you stay with me until the end of this video, you will understand why the brain reacts so strongly during market drops, why fear can override logic, and how disciplined traders train their minds to stay calm during volatile markets. And if you want to continue developing a strong trading mindset, consider subscribing to Bull Mindset. This channel focuses on trading psychology, emotional discipline, and the mental frameworks that help traders remain calm and consistent in financial markets. Now, let us begin with a simple but important truth. The human brain was not designed for trading. The brain evolved to help humans survive physical dangers. Thousands of years ago, threats included predators, environmental hazards, and physical conflict. To survive those threats, the brain developed rapid response systems. When danger appears, the brain activates a survival response. Heart rate increases, muscles become tense, attention focuses on the threat. This response helped humans react quickly and stay alive. But in modern financial markets, this same response can create problems. Because markets do not involve physical danger, they involve uncertainty and financial risk. Yet the brain often reacts as if the danger is physical. Let us talk about the part of the brain most responsible for this reaction. It is called the amygdala. The amygdala acts like an alarm system inside the brain. Its job is to detect threats and activate the body's stress response. When markets drop quickly, or when traders see losses on their screen, the amygdala can interpret this as a threat. The brain does not distinguish between physical danger and financial danger very well. It simply detects a negative event. Once the amygdala activates, the body enters a stress state. Hormones such as adrenaline and cortisol increase. These hormones prepare the body for action. But this reaction has an important side effect. It reduces the activity of the prefrontal cortex. The prefrontal cortex is the part of the brain responsible for logical thinking, planning, and rational decision-making. When fear increases, logical thinking becomes weaker, emotion becomes stronger. This is why traders often make impulsive decisions during market fear. The brain prioritizes immediate action over careful analysis. Now let us talk about uncertainty. Uncertainty is one of the strongest triggers of fear in the human brain. When people cannot predict what will happen next, the brain begins imagining possible threats. In financial markets, uncertainty appears frequently. Prices move quickly. News changes rapidly. Economic conditions shift. Traders cannot always predict the next movement. This uncertainty activates the brain's threat detection system. And when that system activates repeatedly, stress increases. Now let us talk about loss aversion. Loss aversion is a psychological principle that explains why losses feel more painful than gains feel rewarding. If a trader makes $1,000, they feel satisfaction. But if they lose $1,000, the emotional pain is often stronger. This imbalance affects decision-making. During market fear, traders focus more on avoiding loss than on following their strategy. The brain becomes focused on stopping the emotional discomfort. Selling quickly can feel like relief, but that relief is often temporary. Now let us move into real trading examples. Imagine a trader holding a position when the market suddenly drops. The chart turns red. The position becomes negative. The brain detects a potential loss. The amygdala activates. Stress hormones increase. The trader begins feeling anxious. Instead of evaluating the trade logically, the trader reacts emotionally. They close the trade quickly. Later, the market stabilizes and begins recovering. The trader realizes that fear influenced the decision. Now imagine another trader in the same situation. This trader experiences the same emotional signals. The brain still detects uncertainty, but this trader has trained themselves to pause. They check their risk management plan. They review their stop-loss level. They remind themselves that volatility is normal. Instead of reacting immediately, they allow the trade to follow the plan. Sometimes the trade still fails, but the decision remains disciplined. The difference between these two traders is not intelligence. It is awareness of their psychological psychological reactions. Now let us talk about another common situation. A trader experiences several losing trades during a volatile market. Fear begins building inside the mind. When the next trading opportunity appears, the brain remembers recent losses. This creates hesitation. The trader becomes afraid to take the next trade, even though the strategy may still be valid. This reaction happens because the brain tries to avoid repeated pain, but avoiding all risk also prevents opportunity. Professional traders understand this psychological pattern. They evaluate performance across many trades rather than focusing on a small number of outcomes. Now let us talk about mental frameworks that help traders manage fear. The first framework is awareness. Simply understanding how the brain reacts during fear can reduce its influence. When traders recognize that their emotional reaction is biological, they become less controlled by it. The second framework is preparation. Professional traders define their risk before entering a trade. They know exactly how much they can lose. Because this risk is accepted in advance, fear becomes smaller when price moves. The third framework is slowing down. Fear creates urgency. The brain wants to act quickly, but slowing down restores logical thinking. Professional traders often pause before making decisions during volatile markets. Now, let us talk about practical exercises that help control fear. One useful exercise is controlled breathing. When stress increases, breathing becomes shallow. Slow breathing signals the nervous system that the situation is safe. This reduces stress hormones and improves mental clarity. Another exercise is stepping away from the screen. Watching every price movement can increase emotional intensity. Taking a short break helps reset the mind. Professional traders understand that mental clarity is more valuable than constant monitoring. Another helpful practice is journaling. Writing down emotional reactions after trading sessions helps traders understand their psychological patterns. Over time, this awareness strengthens emotional discipline. If this video is helping you understand what happens in the brain during market fear, consider subscribing to Bull Mindset. Because developing emotional awareness is one of the most powerful tools a trader can have. Now let us talk about something important: confidence. Confidence in trading does not come from avoiding losses. It comes from trusting your process. Professional traders trust their strategy. They trust their risk management. They trust their discipline. This trust allows them to remain calm, even when the brain signals fear. Now let us move toward the final message. Market fear is natural. Every trader experiences it. Even experienced professionals feel emotional pressure during volatile markets. But successful traders do not eliminate fear. They understand it. They observe it. They manage it. Let me leave you with a final thought. Markets will always create moments of uncertainty. Prices will rise and fall. News will create excitement and fear. But the traders who succeed are not the ones who never feel fear. They are the ones who understand their mind. They recognize emotional reactions. They pause before acting, and they follow their strategy with discipline. Stay patient, stay aware, and remember that the strongest traders are not the ones who avoid fear. They are the ones who remain calm while fear is present. And if you want to continue building that mindset, subscribe to Bull Mindset, like and share this knowledge with your friends and family. I will see you in the next video.